Hello, and welcome to another episode of the Market Pulse series. So as you all know, today is Thursday. A lot has already happened over the week. So we only have one trading day left before we end the week. And of course, we take a 2-day break on the weekend, then get back to the markets on Monday. So we will be looking at a quick summary of what happened over the week, what we're expecting to be happening tomorrow, that's Friday, and of course, what we will be expecting next week. So clearly, we had 3 central banks set to announce interest rates this week. So 2 have already announced, and the third one is expected to be announcing interest rates tomorrow, very early in the morning. So I would like to begin by focusing on that first. So the first one was the US. Of course, there's quite a number of data that had come up early in the week concerning the US, and this basically built up to the Fed rate decision. So I'm going to filter my economic calendar and just use the US in this case. So since the beginning of the week, I think the most important news for the week was CPI just before the interest rate data. So CPI is short for Consumer Price Index. This is basically a basket of commodities that is used to estimate the average level of prices within the US. And of course, other central banks tend to use similar data. So this basket of commodities basically measured from March to April this month. Then there was a change in price of 0.4%, meaning that the basket became more expensive, indicating that there was rising inflation in the US. So between the month of April and May, then we saw a difference of 0.1%, which was way smaller than expected. We were expecting 0.2%. And this basically implies that the prices are slowing down. And this is the direction that the US Central Bank, or what you call the Federal Reserve, has been looking to achieve. So with inflation rising a very small number of 0.1%, the Fed was very confident that inflation is moving in the right direction. So year over year, that is compared to the same month last year, we saw inflation rising by 4.0%. So remember, the Fed targets to get inflation rates to 2.0%. So it has been a journey moving the inflation rate from a level of 9.1% in June last year to the current level of 4.0, which is very close to the Fed target of around 2%. So there's still more journey to go. So the Fed hasn't quite achieved the target rate yet. So there's still a difference of 2% that needs to be dropped before the Fed stops hiking interest rates. So following this data, we also had what we call the producer price index. So producer price index came in on Wednesday at 3:30 p.m. So this is a measure of what prices. So prices that are basically applied to producers. So in this case, it was consistent at 0.2% as expected. So that is for core producer price index, which is basically the producer price index without food and energy prices. And then for monthly change, we saw a big drop. So while we saw a big rise of 0.2% in April, in May, it was a drop to negative 0.3%, meaning that the next CPI, or the next consumer price index over the next 1 month, is expected to enter the negative territory. And this is along the expectations of the Federal Reserve. So these 2 data points being added to the mix that the Fed considers while making decisions led to the Fed holding interest rates at a level at a range of between 5.0% to 5.25%. So we normally use the upper side of the range. So in this case, that's why we have the 5.25% number. So following the announcement of the interest rate decision by the FOMC, we also had what we call the FOMC press conference. So during the press conference, the Federal Reserve Chair, Jerome Powell, presented a very nice speech explaining the rationale behind this decision and what to expect over the next couple of meetings. So on one of the highlights, he mentioned that he expects that the interest rates will continue to rise and perhaps peak at 5.6%, and that is by the end of the year. So 5.6% seems to be a midpoint between 5.5% and of course 5.75%. So this basically means from the current level of 5.25%, we could see 2 more rate hikes, each 25 basis points each, and that would move US interest rates to 5.75%. So upon the announcement of this news, we had a big reaction in the market where the US dollar continued strengthening, whereas US equities continued weakening. So it was a complete reversal of the pre-existing trends. So later this afternoon, we had more data coming from the US. Core retail sales slowed down to 0.1%. This is also very positive for the Fed. They have been looking to reduce the aggregate demand within the US economy. So this is a slowing down. So remember, retail sales is basically a measure of the receipts or the amount of goods and services that people are basically buying within the US economy. And this is focusing on retail chains. This is basically a measure that is sampled from how much sales supermarkets are making, apparel stores, and other retail chains. So in this case, when you see this number dropping from 0.4% to 0.1%, then it's in the right direction as per the Fed expectations. So for the entire retail sales data, it was up 0.3%, but still within lower than the previous one. So it's a contraction from 0.4% to 0.3%, but not sufficient to get what the Fed was expecting and what the market was expecting, which was negative 0.2%. But still, we can say positively that inflation or prices in the US are getting lower, and this is a good thing. So as per manufacturing, we had Empire State Manufacturing Index, which basically measures manufacturing conditions in New York, basically improved to 6.6 from a previous reading of negative 31.8. And of course, the expectation was negative 15, meaning that manufacturing is pretty strong and very resilient in the US, especially for the state of New York. Then we also had another data point for Philadelphia. So for Philadelphia, the previous reading was negative 10.4, but manufacturing conditions did not improve much. So they also got worse by negative 13.7. So these are some of the two most aggressive states in the US in terms of manufacturing, and they serve as very good indicators of what to expect for the overall population or for the overall production in the US. So import prices month over month also went down by negative 0.6%. And this is also contributing to the narrative that inflation is getting stronger, strongly down towards the 2% target. So also a pretty good and welcome data point for the Fed. Then we had industrial production month over month, slowing down to negative 0.2%. So not very promising. The Fed was looking for industrial production to slow down. So yes, it's slowing down as expected, but in terms of the health of the US economy, this is not what is being expected. So capacity utilization rate, this one remained at 79.6, very close to the expectation of 79.7. And of course, the previous reading was 79.8. So apologies for a minute. Business inventories remained at 0.2%. This was an improvement from the previous reading of negative 0.2%. And then natural gas storage was weaker at 84 billion. And from there, we didn't have any other data point. So as you can see, a lot of data points are indicating that prices are really weakening. And as a result of this, inflation could get to its target and the Fed would stop hiking interest rates. So going forward, we'll be looking at more data. So the Fed, when it announced the interest rates last night, it did not have the data for retail sales. It did not have the data for Empire State Manufacturing Index, as well as the Free Fed Manufacturing Index. So unemployment claims moved higher to 262K. Actually, it's the same from the previous reading, but the expectation was lower at 246K. So the Fed is also looking at a cooling job market. So they want the unemployment claims to be rising. So this is well within their expectations. So as a result of this information, what we are seeing in the charts is a lot of volatility happening. So first things first, we look at the dollar index. So the dollar index is sharply going down despite rising at the early stages of the news announcement yesterday. So after the announcement of the news, we had the dollar rising strongly. But then later today, we had an announcement coming from the European Central Bank where the ECB hiked interest rates by 25 basis points and promised to continue hiking on its next meeting. So as a result, the euro strengthened quite impressively against the dollar. So you can see from this afternoon, the euro has made quite an impressive rally. And we know that when we look at the dollar index is a measure of the strength of the dollar against a basket of other currencies. So the currency with the strongest weight in the dollar index is usually the euro. So if the euro makes a surprise strength against the dollar, then it has a direct impact on the dollar index. So this explains why the dollar index is losing ground. And now when we move to other currencies, you'll notice that the pound is also rising strongly, mainly because we're expecting a strong rate hike coming from the Bank of England on its next meeting. Then for USD CAD, a very sharp drop. So across board in this afternoon, we are seeing a complete reversal. So from yesterday in the evening, there was a big spike in the USD against the yen, continued early morning, but now we are seeing the complete reversal as the US dollar remains weak. So as for gold, yesterday after the news, you can see it was majorly losing to the strong US dollar, but since bouncing from around 1931, there was a force break downwards, got back up, and now has rallied and basically tested yesterday's high. So there is a good chance we'll be seeing some higher prices for gold as a result of the weakness in the dollar, and of course, investors moving into risk-off mode. So we know that equities have been making some impressive rally. So yesterday after the news, there was a sharp drop followed by a recovery. Then today, what we are seeing here is the market starting off very nicely, moving back downwards before resuming strength and rallying all the way up. So as long as we keep on seeing more data supporting inflation dropping towards the 2% target, then the bets that the Fed will not hike interest rates any further become stronger. And as a result, we continue seeing a very strong equities market. So for the NASDAQ, it's a continuation of the bullish momentum. And for the S&P 500, it's the same case, a big jump here, especially after the retail sales data. And now also for the Dow Jones index, it was a big break upwards, and we expect this momentum to continue in that direction. So following the data that we saw with retail sales, among other key price indicators, then there is a good chance that the Fed will continue pausing interest rates. There's no signs indicating that the Fed could go for another rate hike, even though they promised that it's still on the table. So from Jerome Powell's speech yesterday, he basically mentioned that yes, they are looking to get to that peak rate of 5.6%, but the entire journey will be data dependent. So if the data in the economy is indicating lower price pressures, then as a result of that, we know that the Fed will not go for another rate hike. And as a result, we are seeing equities continue to rally and skyrocket, whereas the dollar index continues to take a hit and it's dropping further back downwards. So that's it for the US dollar. And now we may look into the euro. So as for the euro, I will be doing another filter here. So if you know how to use the filter, it's so easy. Makes you narrow down on one currency's news without having to go through all the other news. So for the euro, we have had quite a number of surprises. So I remember last week, we saw GDP data coming from the Eurozone, indicating that the Eurozone had officially entered a recession, even though it's a mild recession, defined by 2 consecutive quarters of GDP contraction. So Germany, 2 weeks ago, also announced that it has officially entered into a recession. So with this in mind, we know that the ECB basically presented a speech later this afternoon, where the ECB president, Christine Lagarde, basically said that they still have to fight this burden of inflation, and they are willing to do whatever it takes. So she hiked interest rates by 25 basis points and promised to go for another rate hike on the next meeting. So German final CPI, which is basically a measure of inflation in Germany, showed a very nice drop to negative 0.1%. This was good for them. So Italian quarterly unemployment rate was on the rise to 8%. Germany ZEW economic sentiment was on the negative side, but an improvement from the previous reading. So economic sentiment for the entire Eurozone was also getting worse from the previous reading of negative 9.4 to negative 10.0. So Then we had the wholesaler price index also going down by negative 1.1%, still within expectations for the ECB. Then industrial production data showing an improvement to 1.0% from the previous reading of negative 3.8% for the Eurozone. So it shows that the European economy is still quite resilient despite being in a mild recession. So going forward, French CPI at negative 0.1%. This was also acceptable. Then later on today, this is when we had the interest rate data, where the ECB went for a 25 basis point hike, eventually moving European interest rates to the 4% level. So on the next meeting, we expect even further rate hikes. So when you compare the two central banks and what they are doing, we know that the Fed has reached the end of its rate hiking cycle. And if we keep on seeing lower price pressures, then we know that the Fed could be considering cutting interest rates towards the end of the year or in early 2024. However, for the Eurozone, we know that the inflation is still high. So there is a good chance that the Eurozone will be going for more rate hikes. So this may explain why we are seeing a very strong momentum in the Euro USD currency pair. And of course, tomorrow you'll be seeing more data for the Eurozone. And this is the final CPI, or final consumer price index, which previously stood at 6.1%. So if you compare this with the US is at 4%, very closer to the target of 2%. But for the Eurozone, they still have a long way to go because they need to drop inflation by 4.1% to get back to the target of 2.0%. So still a long way to go. Core inflation at 5.3%, still a huge challenge. And of course, we will be expecting more data tomorrow. And of course, the Italian trade balance to basically show us the difference between exports and imports in Italy. So following this, now when we look at the euro dollar and how it has been trading, you'll notice the sharp momentum that happened here. So it was almost like a breakout. So from the forward chart, we have had this market obeying this particular trend line for quite a period of time before it eventually broke the trend line around here early in the week. Prayed around here yesterday, made a short upwards, pulled back, and then today moved all the way up. We haven't seen such a 4-hour candlestick in quite a while in the Euro USD. And this is indicative of a very strong recovery in euro dollar prices. And there is a good chance that as we trade tomorrow, we could be seeing the euro dollar attempt to cruise even higher towards the previous high that we saw in mid-April. So there is a good chance we'll be seeing the euro dollar trading at 1.10896, which is the previous high. So if you have any questions relating to the presentation, feel free to type them in the live comment section, and I'll be responding to those questions right away. So hello, Sue Jones. Hello, Humphrey Mushoga. Thank you guys for joining in. I always appreciate having you on the session. So if you have any questions, just type them and I'll be responding to them right away. So next part is what we expecting tomorrow. And this is an interest rate decision from the Bank of Japan. So let's do another filter here. We go for the JPY, remove the euro, apply the filter. So we've had a smaller number of data coming from Japan this week. So producer price index was down to 5.1%, meaning that inflation pressures are slowing down in Japan. Preliminary machine tools orders at negative 22.2%. This is a weakness. And of course, the BSI manufacturing index coming in at negative 0.4. This was an improvement from the previous reading of 10.5. So core machinery orders came in stronger than expected at up 5.5% in the last 1 month compared to a previous reading of a contraction of 3.9%. So trade balance improved to negative 0.78 trillion from the previous reading of negative 1.04 trillion yen. So this was also a very good data point showing the resilience of the Japanese economy. And of course, we had the tertiary industry activity being up 1.2%, and the previous reading was negative 1.5%. So with these data points, we saw increased optimism in Japanese equities, and the Nikkei 225 index managed to break a 30-year high And this was quite impressive, especially for Asian stock traders. So tomorrow, we'll be looking at an important data point, which is the BOJ policy rate. So the Bank of Japan has maintained interest rates at negative 0.1% for quite a lengthy period of time. So if you extrapolate here all the way back to 2016, so interest rates have been consistently the same at negative 0.1%, as the Japanese economy has been fighting deflation for the last 2 decades. So in order to achieve high inflation for Japan, they have been doing a lot of quantitative easing to try and stimulate the economy to the right direction, while holding interest rates at negative 0.1%. And of course, we know they have a yield curve control program on 10-year bonds, which was recently expanded to 0.5% plus or minus, compared to the previous limit of 0.25% plus or minus. So on this meeting, we'll not be expecting any change. Nothing has really changed in terms of monetary policy. So we will be expecting the Bank of Japan to maintain interest rates at negative 0.1%, which is quite negative for the Japanese yen. So very low interest rates plus quantitative easing tends to be heavily or highly inflationary for the currency. So you tend to see the currency having the lowest interest rates become weaker against other currencies that have higher interest rates. Apologies for that. So whenever you have high interest rates, we know that investors will be looking to buy bonds in that economy. The citizens of that economy will tend to be encouraged to save more because the returns are higher. And in that case, the currency becomes more and more scarce. And as a result, the currency gains against other currencies. So for the Bank of Japan, it's a negative 0.1%. The most important data point will be the monetary policy statement and, of course, the Bank of Japan press conference. So during the press conference, which is expected to be around 1 to 1:30 a.m., a couple of hours from now, we will be expecting to see the new Prime Minister issue some forward guidance, description of where the economy is, where they're expecting the economy to be over the next couple of months. And of course, this will have an impact on the movements of the Japanese yen. So my personal projection is that there's a good chance we'll be seeing the Bank of Japan, the Japanese yen continue to weaken against other currencies. So besides this, there's also next week. So remember, the morning market snapshot series we'll be doing Monday to Friday. But for the Friday episode, it will be done by one Samson Mzera from Eldoret. And hopefully we'll be able to deliver more value across the entire week. So make sure to tune in for the market snapshot series tomorrow. So for next week, there's quite a lot that we'll be expecting. But before I conclude on Friday, I'm just checking to see if there's anything more. So of course, for US, we'll be seeing the preliminary University of Michigan consumer sentiment data, as well as a inflation expectation survey. So this will be happening at 5 p.m. So volatility will be expected early in the morning during the BOJ press conference, midday for European inflation data, and of course in the afternoon at 5 p.m. after the consumer sentiment and inflation expectations data is announced. So now we look at the next week and what we'll be expecting for next week. So on Monday, we don't have a lot of stuff happening. There will be Bank of Japan summary of opinions, SPPI. This is services purchased by corporations. This will also be an important data for Japan. BOJ core CPI. This is a consumer price index without food and energy. And of course, German IFO business climate, before we look at M3 money supply and CBI realized sales for the UK. So besides this, this is a technical traders territory. So once you get through this, volatility will resume on Tuesday when we get to see inflation data from Canada. Then later on, core durable goods orders for the US before we look at durable goods orders at 3:30 p.m. on Tuesday. Then CB consumer confidence for the US at 5 p.m. on Tuesday. Still, we also be looking at new home sales and Richmond manufacturing index. So Wednesday, CPI for Australia, a very good measure of inflation. That will show us how inflation is trending in Australia. There will be Tokyo core CPI on Thursday, early, before we look at retail sales for Japan. Then Germany preliminary CPI, which is a leading indicator of European inflation. Then final GDP for the US at 3:30 p.m. on Thursday. Then once we get to Friday, we'll be seeing some Chinese data, manufacturing PMI, as well as a non-manufacturing PMI. Final GDP for the UK, Euro CPI flash estimate, and of course, GDP for Canada, and of course, core PCE price index for the US. So it seems like a pretty quiet week. So if you are technical traders who avoid trading news, then next week will pretty much be the best week for you when there is little to no announcements happening in the markets. In that case, the markets tend to obey out of our technical price levels. So apologies, everyone. I needed to clear my nose a bit. I think flu is catching up with me. So hopefully I'll be fine once I resume the sessions on Monday. So besides this, I don't think there's much to think about. So for gold, the immediate price level target after breaking this high of yesterday will be the 1964 price level, and perhaps some further upside momentum to 1970. But for now, if we see some form of weakness and market pulls back, then the key level to observe will be the 1953 price level. So as for Brent oil, we are seeing some continued momentum upwards. So after having seen this bottom last week, market pulled back yesterday, and now we are seeing some further momentum. So there is a good chance we'll be seeing Brent oil prices test the $76.49 dollars per barrel price level. So it was a pretty good setup on the forward chart, market bouncing the second and now the third time. So we had a good rally, market pull back downwards, and now it's a continuation. So some further upside is expected to be seen in Brent oil prices. So US dollar against the Chinese yuan, you can see the sharp drop happening here after almost vertical movement on the daily chart. So it's a welcome breather for the Chinese currency. So some further downside could be expected here, especially considering that major trend lines are already been broken. So if you zoom out here and look at the 1 hour chart, then you'll notice and the market is almost breaking this trend line here that was acting as support. So this is the area. So it's currently testing that support. So a break below would basically imply that you'll be seeing some lower prices. So I will be checking to see if there is any questions or comments. So if there's no questions or comments, then I would like to end at this point. So very good comment from Isaac. I want to say thank you, Rufas. Today, Imagine Gold treated me super great. You can send something. I have an M-Pesa number. Thank you. I will appreciate that. So thank you very much, guys. And I hope to see you on the next session.